you ever wondered how you can give significant gifts to your loved ones without worrying about the IRS? Or are you looking for ways to reduce the size of your taxable estate? If this is true, this episode is for you. Welcome to Navigating Estate Planning with Caress Law. I'm Tammi Caress. Today, we're talking about the Annual Exclusion Gift and how you can use it to reduce your taxable estate and pass wealth to your loved ones tax-free. And now it's time for the disclaimer. The information contained in this podcast and associated material is intended to furnish listeners and users with general information on matters that they may find to be of interest. The information in this podcast provided by Caress Law and its agents are for general guidance and is not intended to replace or serve as a substitute for any advisory, tax, estate planning, or other professional or legal advice, consultation, or service. Sometimes we may reference third-party materials or websites. Such links or references are only for the convenience of the listener, user, or browser. Caress Law and its agents do not recommend or endorse the content of third-party information or sites. You should consult with appropriate Caress Law professionals or other professional advisors for advice concerning specific tax, estate planning, or other matters before making any decision. In summary, this podcast is not legal advice. If you need legal advice or before acting or making any decision with anything talked about in the podcast, seek the counsel of an attorney. Thanks so much. I can't talk about the Annual Exclusion Gift without first talking about gifts in general. When we are discussing gifts in the realm of estate planning, we are talking about gifts of property. I know there's lots of other great gifts that you can give others that are not property, but today it's all about property. Property are, cash, stocks, bonds, a car, interest in a business, could even be a residence or a home. So any sorts of property that you have in your estate can be gifted out. Now, when we talk about a gift, there are actually steps to a gift that people don't realize. A lot of times these just happen when you make a gift, but I just want to be very clear. When you make a gift, that means you are actually relinquishing control of that asset. I have many clients come in to me and say, oh yeah, I've been putting money in an account aside for my grandchild or niece or nephew, a loved one, and it's their account and I've gifted it to them. And I say, okay, is their name on the account? Are you making a transfer to them? Oh no, I have it earmarked for them. And then I take it out and use it whenever, they need something. Maybe they need books for school or something like that. That is not a completed gift, which means that account that money has been put in and set aside for a certain person has not actually been gifted. So just some things to think about. To make a gift, you must transfer that property type to the individual and they must accept it. For example, if you give someone $5, they take it. And at that point, they can spend the $5 however they want. They've accepted that gift. Effectively, that is a completed gift. Now, there is such a thing called the gift tax, and it is a tax assessed on gifts made gifts made during lifetime. Okay. So don't worry. A lot of people are not fully subject to this tax, but many of you are. So this is why it's good to know. Essentially, each person has a gift tax exemption amount that the IRS allows gifting to be done. And if gifts are made over your lifetime that exceed this exemption amount, then gift taxes are assessed. And how the IRS knows that you've exceeded that gift tax exemption amount is because when gifts are made, gift tax return form 709 is required to be filed. And that's usually filed when you file your individual income tax return annually. So when this return is filed, Form 709, whatever gift amount you made, if it's under your gift tax annual exclusion, what it does is reduce that annual exclusion amount. Okay, so the annual exclusion is quite high, and we're talking on the federal level here, not on the state level. On the federal level for 2024, the gift tax exclusion amount is $13.61 million. You've probably heard me talk about the estate tax exclusion amount, which is also $13.61 million. They are associated with one another. So anytime you make a lifetime gift, you are reducing your gift tax exclusion amount. You're also reducing the estate tax exclusion amount. So at passing, estate taxes could be assessed on your estate if you've used up that exclusion amount. And I hope I didn't confuse too many of you on that. I do have prior podcast episodes talking about these specific taxes, so definitely go back and listen to those if you have some questions there. When it comes to the gift tax annual exclusion, it is an exception to filing that Form 709. And what it means is when you make a gift to any one individual annually or in a given year, calendar year, and if that gift is under, for 2024, it's $18,000. So if that gift is under $18,000, there's no reporting requirement. So no filing of the federal gift tax return Form 709 that I previously mentioned. It does not reduce your estate and gift tax exemption amount. It's essentially a tax-free gift. So this can actually be a very powerful tool. And I wanted to talk about it because we are nearing into the fall months, and then things are going to get really busy, usually during the holidays. And you only have a couple months, 4 months at this point, but 4 months goes by pretty quickly to start thinking about this for the 2024 tax year. So how does this work? The IRS limits are $18,000 per recipient. What does that mean? That means if you have 3 children and you want to give them each up to $18,000, you can do that in 2024, and you don't have to file a gift tax return, and there's no taxes assessed on that gift. A lot of times I have clients who will make a gift in December of one year, and then they make a gift in January the next year. So you're into 2 tax years in making this annual exclusion gift. We don't know yet what the 2020 or 2025 limits are, but they are adjusted for inflation. Usually it's going up about $1,000 a year. We think estimated it's going to be around $19,000 that you can gift tax-free in 2025. But this year it's 2024. So who can benefit from this tax? Obviously, your family and individuals. Many times I have parents and grandparents, or those who don't have children, might have nieces and nephews that they want to pass and transfer wealth to. And what's really great about this annual exclusion gift is it's annual. So you can give this gift annually to the same recipient. It's a way to pass wealth to those you love. And it also removes that asset from your estate. So when you pass, it cannot be subject to the estate tax because you don't own it anymore. This is a really great strategy for families and individuals who don't want to deal with filing that tax return and who do want to reduce their overall estate value so that they pay less in estate taxes. This gift is a really great thing. You can actually, when I say recipient, it's any person. So I have families that will give it to their child's spouse, their grandchildren, and so on. And it can be a really, really great tool. By the way, this is per individual. The gifting person is yourself, but your spouse, if you're married, also has the ability to make gifts. So if you're married and you have a child that you're gifting to, you can actually double that and make that $36,000 $18,000 from each gifter to a child. So that can add up pretty quickly if you're trying to look for strategies to lower your estate value and thereby minimizing your taxable estate when you pass. I also want to talk about blended families. My last two episodes talked about blended families and some planning techniques with those scenarios. But when we talk about gifts, a donor, the person making the gift, can, if they are married, they can actually use their spouse's $18,000 gift exclusion amount. We call this a split interest gift. And so if I, for example, want to make a gift and I have assets in my account that's my separate property and is not the property of my spouse, I can make a gift of $36,000 to my niece, for example, and my spouse is considered joining in that gift, even though the full gift came from my assets. And so this is a great tool when you have a blended family. I have lots of families that keep their assets separate because maybe it's their second marriage, they're much later in life, and when they got married, they're completely established, separate from one another prior to the marriage, and they've just decided to keep things separate. Well, this can be a great tool if you want to gift a little bit more to your loved ones and remove those assets from your estate. When you make these kind of gifts, you want to make sure that you're still keeping a record of them. And there's a couple of reasons why. One is it's just good to know, right? How much are you gifting? I do have scenarios quite often actually where clients are in front of me and they have talked about, well, I've kind of given a little bit more money to this individual, and I don't think it's fair because my other two kids are, they've done well, they're well off, they don't really need the gifts. My other kid just has a little bit more needs than the other two, but I also feel guilty that I have made a large amount of gifts to one child and not the other two. What can I do to make this up? Well, we can actually, in the estate plan, we can make it up, and we can actually make gifts advancements to inheritance. And when we do that, it's a way that essentially equalizes assets when you're gone and it goes out to your loved ones. So it's really good to keep a record for that reason, if that's something or a tool that you want to make sure you implement into your estate plan. But also, I have had clients that come into me who I've said, okay, you've made some gifts to one child over the other. Can we start adding these up? And they do and realize it is substantial, and they didn't realize how substantial it really was until we made them add them up. And then we might have the discussion of turning them into advancements to inheritances. And so anyway, just good for record keeping purposes. Make sure before you make the gift that you know what the annual exclusion amount is. 2024 is $18,000. We don't know yet what 2025 will be. And then know that you can make them to multiple recipients. And that's how you get that asset out of your estate, because it's a completed gift, and you reduce the amount subject to estate taxes. Now, I've been talking federally here. When we're talking about these gifts, I encourage you to look to your state law to make sure that there isn't any state requirements that might be different than what I'm speaking about today. I can tell you that Oregon and Washington do not have a gift tax. So that's actually a really great tool in terms of estate planning. So there's no reporting requirements when you make a gift to any individual in the states of Oregon and Washington. However, this $18,000 federal annual exclusion amount can still be used to reduce your estate, even for estate tax purposes, in states like Oregon and Washington, where the threshold to be subject to those taxes are quite low, and they're much lower than the federal level. It's also good as well in reducing your estate for federal estate taxes if you are a high net worth individual. But even if you're not a high net worth individual in today's standards, that federal estate tax exemption amount is a moving target, meaning it changes. I remember when I first started practicing, it was $1 million. So it's gone up to 13.61. It is now under current law set to go back down to $5 million adjusted for inflation in 2026. So just really good to keep your eye on the ball when it comes to the federal estate taxes, because although you don't think you are or you're not subject to the estate tax now, you could in the future because it is a moving target. Usually it moves when we change presidents or change Congress in some way. A few other special caveats or considerations to think about. You always, when you make a gift, you want to make sure that you are leaving enough for yourself to live on. You do not want to make a gift to try to reduce your estate so that there's no estate taxes or a minimal estate taxes and then need it later on. I have had to counsel many clients on this who are trying to minimize their estates because of Oregon or Washington's estate tax low threshold amount. And they say, well, I'm just going to take my $500,000 bank account and I'm just going to give that to my children. Now they're going to put it aside and they'll use it for me if I need it later. Well, that's actually not a completed gift. So if it did get challenged in the future, it might be difficult to prove that that's a completed gift. But you also don't want to rely, remember, you relinquish control to make it a completed gift. And you don't want to rely on someone else, including your children, to use this money for you. That you could have someone who says, oh yes, I'll go ahead. You're giving it to me. I understand it's for tax planning, but it's really yours. Again, not a completed gift. But aside from that, you don't want them to say that. And then maybe they all have their own financial difficulties that were unforeseen. And they think, well, I have this money over here in this account. It won't hurt if I pull just a little bit out to pay these bills or whatever it may be. It's just not a good idea. Not a good idea. Before you make any of these gifts, I highly encourage you to talk with your financial advisor about making strategic gifts. You also can consult with your CPA and definitely with your estate planning lawyer. That's because there are some property that might be better to gift than some assets that might be better to gift than other assets. And I'm talking about the cost basis here. When you make a gift, your cost basis in that asset transfers over to the person you're making the gift to. And if that person sells the asset, they could incur large capital gain costs as opposed to maybe keeping that asset in your estate and gifting another asset that has a higher basis. If you don't understand what I'm talking about in terms of cost basis, I again have another episode discussing that. Okay. I hope this information wasn't too dry and boring for you. I do think this is a valuable tool that can be used. And just a reminder, I know I used examples of cash or a bank account, but there's lots of other types of assets that you can pass, such as family-owned business. If you have a family-owned business with a business interest, a membership interest, and an LLC, you can actually start gifting out the LLC membership interest to lower the value that you own in that business. And therefore, at your passing, the business value, your ownership value is less. So lots of different types of assets that can be gifted under this annual exclusion, just talk to your estate planning attorney, talk to your CPA, definitely make a strategic gifting plan with your financial advisor. All right, to recap, the annual gift tax exclusion amount is the amount that you can gift to any recipient in a given year without having to pay a gift tax or file a gift tax return. That threshold is $18,000 for 2024 and can be a really great way to pass wealth to your loved ones and reduce your taxable estate at death. Thank you so much for listening today. And if you have or you know somebody who needs estate planning help or help with probate or trust administration because a loved one has passed, please go on over to our website. We have plenty of materials for you. And if this person is a Oregon or Washington resident, or they own property in either of those states, we can certainly help. And I encourage you to reach out to us through the website. If you're enjoying this podcast, I also request you leave us a 5-star review. It's just super helpful to spread the word and get our name out there and help others in their estate planning journey. Thanks so much, and until next time.